Hi there, you're watching Aardvark Tax TV. I'm Sean, I'm an enrolled agent and customer service representative here at Aardvark Tax. Today's topic is going to be renewable energy credits and deductions. And if you're taking this as part of an Aardvark Tax course, then terrific, you're going to go ahead and get credit for this with both the IRS and California if that's applicable. If you're not taking this as part of a course, then you're missing out on that credit. So if I were you, I'd head on over to www.aardvarktax.com. and the link will be below. And go ahead, sign up for one of our courses to ensure that both of those governmental agencies know that you've watched this video and apply credit for it. If you're just interested in taxation and watching this on YouTube, then don't forget to subscribe. So again, we're going to be talking today about renewable energy credits and deduction, and that's because it's a topic I'm really interested in. I live about 100 miles east of Los Angeles, and renewable energy is plentiful here. So let's go ahead and get started. There's a lot of sun in the Southern California desert, and there's a lot of wind in the Southern California desert too. That makes it a perfect place to collect renewable energy. As we go into more populated areas, we have a huge amount of space and lots of low-level buildings, and that allows us to harness a lot of the sun through solar panels. Parking lots in the Coachella Valley often have covers to help protect cars from the hot sun, and many of these covers are huge solar farms that deliver back energy while people park beneath them. Even our trash cans are solar collectors. And that's good because we're using a lot more electricity for things like electric cars here. The US government and California both have some really good incentives for buying electric cars. As our population grows, there's a lot more building going on. And new laws in the state are going to force builders to add solar panels to pretty much every new home. So renewable energy and its tax ramifications is going to touch a lot of people as this space gets filled up. So let's start with residential real estate. So credits for your house, they haven't been around very much. You've had tax stuff associated with your house, like the mortgage interest deduction, property tax deduction, the sales exclusion, and obviously you've kept track of the basis of your house, meaning how much you paid for it, how much the improvements are, so that if you ever don't meet that sales exclusion, you can go ahead and pay as little capital gains as possible. But actual credits associated with your residence have been few and far between. Now, in 2013, Congress enacted several credits that applied to your residence, one of which was a residential energy credit, which is still good, and another part of the credit called the non-business energy credit, and that had to do with efficiency of your house, so things like insulation or a new fuel-efficient furnace, things like that. There was a $500 limitation to that one, so it wasn't as valuable as the main part of the credit. But regardless, Congress did not extend that this year, and it doesn't look like they're going to, though officially, as of this taping, it could still happen. We're taping this in January 2019, so Congress could still extend it, and if that's the case, you'll want to make sure you know, because some of that energy-efficient stuff can add up. In the 2018 Budget Act, the residential credit for solar and other energy properties was extended until 2021. So you can still take that credit against your house, and it's a really good one. It's worth 30% of whatever cost you incurred to install that property. And that includes labor, that includes the materials. So what kind of property are we talking about here? We're talking about solar panels on your roof, or we're talking about solar water heaters, geothermal heaters and energy collectors, wind turbines for your home, even fuel cell pumps, even though there are special rules associated with fuel cell pumps that make it a little more complicated. All of these types of properties are applicable to that 30% credit that you can apply on the tax return in the year that the property was upgraded with that material and the project was complete. So for instance, if you pay for solar panels in December, but they're not installed until January, you can't take the credit until the year of January where it was completed. So what kind of residential real estate are we talking about here? Well, we're talking about your basic house, condos, manufactured homes, even houseboats, anywhere where you create a domicile or keep as a vacation home. Now, unfortunately, rental properties are not included in this mix. There is some controversy there. The IRS put out a notice in 2013 saying that residential properties were definitely excluded, but then some other people read the tax code and said, well, maybe not so much. It is pretty accepted at this point that if you rent your property for part of the year, but you use it for personal use the other part of the year, at least the personal use part can be prorated to use the credit. But again, that's something you're going to want to look into further if the property is used for rental at all. But the rental part is only one limitation associated with this credit. There's four. The first is can't be used for rental properties, can only be used for your homes that you use as a resident, but not just your main home, that includes your vacation homes. The second limitation is that you can't double dip. So if the basis for your property is $400,000 and you add $25,000 of solar to that, this does not increase your basis to $425,000 if you've applied that money to the credit. If you've applied the money to the credit, your basis stays at $400,000, but you get that 30% credit. Typically that credit is going to be a whole lot better than being able to increase your basis. So that's not such a big deal. The third limitation is that any rebates that you might have gotten from a private entity to help support you in your endeavor to put these kinds of energy properties on your residence, you have to remove those before you can apply it to the credit. So for instance, if I spent $25,000 on a solar panel system and I got a $1,000 rebate from my local energy company to help me do that, then I can only apply $24,000 to the actual credit, and I would take 30% of that as my credit. I can't do the $25,000 and double dip and get that $1,000 rebate as well. So that's no double dipping on your basis. That's no rebates can be applied to the credit. It can't be applied to your rental property. And the fourth one is that it is a non-refundable credit. And what that means is that you can only use the credit up to the amount of your tax liability and no more. So this isn't something like the child tax credit where you can get more money back as a refund than you paid in. You can only get this to cover your tax liability. Now that's not to say that you'll lose it forever if you don't have enough tax liability to cover it, because it can roll over to future years. But it's something that you're going to want to talk to your clients about, especially if they have limited income and limited tax liability every year. This is set to expire in 2021, and the rollovers as well will expire when the tax credit expires. So if you put that property in place in 2019 and then in 2021 Congress does not extend the tax credit, that means you only get 2 years where you're going to be able to apply that rollover. And if you don't have any tax liability for the next 2 years, that's money that could go away. So you're going to want to talk to your clients about possibly selling some stock that they've been meaning to sell, or do some other kind of expenditure so that they get the benefit of that credit before it possibly goes away in 2021. I have heard several Congress people say that they do not choose to extend the credit. That's not to say that Congress won't completely turn over in the next couple of years. Who knows what could happen? But for right now, I wouldn't depend upon this credit going farther than 2021. Okay, so now you understand the credit, but how do you get it? Well, the answer is Form 5695. You're going to go ahead and fill that out. The first few lines are the types of properties that you've installed and how much cost you incurred to install them. And then you'll fill out a worksheet which will make sure that you don't go beyond your tax liability by including all the credits, for instance, child tax credit, things like that you might be taking this year. And once you have that information, you can transfer it over your 1040 and you are good to go. So where does California fit into all of this? Well, California does not have a tax credit like the feds do on this one. So You cannot, apply to the state of California and get a residential energy property credit for your solar on your roof. There are other things you can do. For instance, you can go to your local electric company. Sometimes your local jurisdiction will have incentives and rebates applicable. Again, no double dipping. You'll have to remove those from your total amount before applying for the credit. If you are in a state other than California that allows for a tax credit associated with installing this kind of property, you do not have to remove that from the federal credit. Those two live completely in isolation from each other, so you don't need to worry about double dipping there. That's one area of good double dipping. But there are other incentives that you can look at in California that will help your clients. As an example, some counties, like my county here in Riverside County, will allow you to reduce the appraised value of your property by the amount of solar that you installed. For instance, if I were to have bought this house and the builder put solar on the roof, I can then apply to the state after the purchase was made and decrease my appraised value so that it does not affect me for my future property tax years. This is not going to be as big of a deal if you're doing an aftermarket installation of solar because your appraisal value would have gone up with the addition of that solar panels, and now you're just bringing it back down again. So you would just not have it be part of the appraised value at all. But as California makes more and more laws regarding the addition of solar panels onto roofs as part of new housing building, we're going to find more and more that this new way of lowering your appraised property value can be very effective for clients who have bought new homes that were just built. So now that we talked about residential energy credits, let's go ahead and talk about the credits associated with vehicles and renewable energy. The first is the Qualified Plug-in Electric Drivetrain Vehicle Credit, or Form 8936. We would use that if we bought a new car that had some aspect of electric drivetrain with some limitations that I'm going to talk about in a second. And we would fill out that form and apply that amount to our 1040 to get that credit. Now, there used to be a second credit, mostly for fuel cell vehicles. It was the Form 8910 for alternative motor fuel vehicle credits, but that ended as of 2017. So there are still ways that you can take that, but it's such a strange way that you would have to take it that we're not even going to discuss it in this video. So instead, we're going to focus on Form 8936 and the type of cars and that you might use for that credit, because this is another very valuable credit. It's worth $7,500, which is a lot of money. For any vehicle that was bought and owned by the taxpayer before January 1st, 2019, every car that was sold that meets the limitations is worth $7,000 or $7,500, sorry, which is really, really valuable. Now, as of January 1st, 2019, one car manufacturer no longer meets that number. There's actually a lesser amount for that vehicle, and that's for Teslas. And that's because the way Congress wrote this law is that in the quarter following the quarter where the manufacturer sells its 200,000th car, electric vehicle car, then the credit gets halved by 50% for 2 quarters, and then another half down to 25% for 2 more quarters, and then the credit goes completely away for that manufacturer. So as of January 1st, 2019, Teslas now get $3,875 for a vehicle purchase, whereas all the other manufacturers who are selling electric cars are still at the $7,500. Now, what kind of cars are we talking about here? Well, we're talking about any car that has an electric drivetrain of at least 2.5 kilowatt hours reserved for that electric drivetrain. Now, that can be packaged together with a combustible engine, such as a Prius, for instance, which is a plug-in hybrid, where it gets a certain amount on electric before it switches over to its combustible engine. And that's the first limitation associated with this credit, is that 2.5 kilowatt drivetrain associated with it. The second limitation is that the car has to weigh less than 14,000 pounds. The third limitation is that the car must be able to go at least 45 miles per hour. So that means things like golf carts are not going to be able to get this credit because they are not designed for highway use. The final limitation on this credit is, much like the residential energy credit, is that the credit is not refundable. And what that means is that you can only take the credit up to the amount of your tax liability for this year that you bought it and put it into service, or you'll lose the credit altogether. In fact, it does not roll over to future years like the residential energy credit does. So if you don't use it all in the same year that you bought the car, you lose it. So an important thing to remember about vehicle credits is that they apply to the owner of the vehicle, be that a person or an entity, and not necessarily to the person driving it or renting it or leasing it. If you lease a vehicle, you do not get this credit, and you cannot apply for this credit. The leaseholder, or most likely the dealership who leased you the car, is going to get the credit. Now, what some dealerships do is they go ahead and apply the credit to the lease as an incentive to have you buy it or lease it. So it's still possible that you'll get the benefit of the credit, but you won't have the ability to apply for it through the form of the IRS. Now, since I mentioned that the leaseholder can take that credit, you understand that business folks can also take advantage of this credit. The big thing that they have to remember, of course, is that the basis of the vehicle will decrease based upon the amount of credit that they receive for it. So they'll want to make sure that they understand that when they are disposing of the vehicle later.
And what about California? As you're charging your car, you're probably wondering the kind of tax goodies that California will provide for renewable energy items. Well, California doesn't offer its incentives through tax credits. Instead, it has a program called the Clean Vehicle Rebate Project, or CVRP. The CVRP program makes it easy for your clients to go to their website, provide some information and documentation, and apply for fairly generous rebates for their electric or fuel-celled vehicles. You can advise your clients to get the rebate site by typing https://cleanvehiclerebate.org. Once there, they can apply for rebates of up to $7,000. If they have a fuel-celled vehicle, they can get $5,000. If they have an electric battery vehicle, they can get $2,500. For a plug-in hybrid, they can get a $1,500 rebate. And finally, for an electric motorcycle, they can claim $900. But these rebates come with a catch. While they used to be available to all, now they are limited by income, and the CVRP program will make you fill in a tax transcript request form to ensure that you qualify. The income is based on your gross income listed on your tax return in the first section of the 1040. If you're single, you cannot receive the rebate if you made over $150,000 last year. For head of household, that's raised to $204,000, and if you're married, it's $300,000. But for people with low incomes, the rebate program is even more generous. For anyone making less than 300% of the poverty level, they can apply for a rebate and get an extra $2,000. For instance, if they have a battery-powered vehicle, they can get $2,500 plus $2,000, or $4,500 total from the rebate program. That's a pretty good deal and makes electric vehicles much more affordable for those with lower incomes, especially when it's combined with the federal credit. As part of the CVRP program, California also provides HOV decals for driving in the carpool lanes. In most cases, you cannot get both the rebate and the decals, and you have to choose one or the other. The decal program is still available to those who cannot qualify for the rebates based on their income, but keep in mind that the decals have a shelf life. The red and purple decals that are being provided now by the CVRP program will only last to 2022 or 2023, and then you won't be able to drive in the HOV lanes anymore with them. Previous decals, including the yellow, green, and white ones, have already expired and are no longer permitted to use the HOV lanes. Finally, even though it's not tax related, you might advise your clients about time of use programs provided by local electric companies as a value add. This allows folks who own an electric vehicle to charge their cars for less during late night and early morning hours when electricity is not at peak demand. Okay, that's it for this vlog. It was long, I'm sorry about that, but we had a lot of information to cover. Stay tuned to this YouTube channel for more videos like this in the future.